Danny from Wicked Cool Finance here. On today's video, we're going to talk about the 3 absolute best tax-free accounts to put your money in to save for retirement. Now make sure you stay towards the end of the video, because the last account is going to be kind of a surprise for you. Now, why are we talking about this? Why all the rage about tax-free? Well, the reason is because in retirement, you will see when you get there in retirement, taxes will be your absolute worst nightmare. Let me give you a specific example to help you understand why taxes are such an absolute nightmare. My father's had the same car for about 20 years, and as of late, his car's been giving him a hard time. So next year, he's probably going to buy a new car. He's been looking at Honda Accords. Now, cars are so expensive these days. The average Honda Accord, depending on what you get on it, costs about $35,000. Well, my dad keeps most of his money in what is called a traditional IRA. With a traditional IRA, when you take the money out, it comes out as income and you have to pay tax on that. Well, my dad's next year going to take out $35,000 to buy the Honda Accord. Well, when he does that, he's going to have to pay tax on that $35,000. How much tax is he going to have to pay? Probably about 25% in taxes. Some will go to the federal government and some will go to the state, but roughly about 25%. Well, if he takes $35,000 out of his IRA, he has to pay tax on it, and that 25% will add another $8,750 to the cost of the car in the form of income tax. But hold it. He took another $8,750 out of his traditional IRA. Now he's got to pay tax on the money that he took out to pay tax with. So the tax, 25% tax on the additional $8,750 is $2,187. It's never ending. So the total cost of that car, it's not going to be $35,000. After you take into account all of the income tax that he pays on the money, it's going to cost him more than $45,000. Well, let's talk about the first tax-free account. That is pretty awesome. It's the Roth IRA. With the Roth IRA, you can put money in. The money grows throughout your lifetime up until retirement, and retirement is defined as age 59 and a half. After 59 and a half, you can take all the money out and use it for whatever you want, tax-free. Pretty cool. The second type of account, called a Roth 401k. If you're eligible for a 401k at your company, you likely have a Roth option in it, and you should be using it. Now, if you don't have a Roth option in your 401k, all that you need to do, no big deal, is pick up the phone, call your HR manager, alert her to this or him to this, and they will simply call the 401k administrator and ask them to add the Roth feature. It's pretty simple, probably doesn't cost any money to the company, and the administrators, with a click of a mouse, can add that feature. Now, how much can you put in a Roth 401k? You can put up to $23,000 in 2025. You can put up to $23,500 into the Roth 401k. Holy cow, that's a lot of money. And as that grows and compounds over time, when you get to retirement, yes, at 59 and a half, you can take the money out and use it for virtually anything, and you pay no tax. Now that brings us to the third account. The third account is kind of a surprise. It's not an IRA, it's not a Roth IRA. What is it? It's a health savings account. Health savings accounts are absolutely awesome. With a health savings account, it is triple tax-free. When you put the money in, first, you get a tax deduction. As the money grows, it grows tax-free. And when you take the money out in retirement after the age of 59 and a half, if you use it for qualified medical expenses, you pay no tax. So it's tax deductible, it grows tax-free, and when you take it out and use it for qualified medical expenses, you pay no tax. Triple tax-free. Very, very cool. Now, there are some limitations before you can there's some rules that you need to know before you can put money into a health savings account. To start with, you have to have a high-deductible healthcare plan. What's that mean? Well, if you're single, your high deductible would be $1,650. If you're a family, then your deductible would be your high deductible would be $3,300. And on top of that, there's a thing called an out-of-pocket maximum. This is the most amount of money that you would spend on your medical needs throughout 1 year if you have a group health plan. The out-of-pocket maximum that you can have for a single person on your group health plan is $8,300, and for a family, it's $16,600. But if you meet those rules, if you meet that criteria, then here's the cool thing. You can put up to, if you're single, $4,300 into an HSA. If you're married, as a family, you can put up to $8,550 into an HSA. And you absolutely should be doing it. So I highly encourage you, if you're eligible, if you have a high deductible healthcare plan, please consider putting money into the HSA and don't spend it. Make sure you keep that money in there until retirement and then take it out for qualified medical expenses and you will be so happy. Now, you may say, qualified medical expenses, that's all I can use it for? Well, if you want tax-free, yes, that's all you can use it for. But mark my words, in retirement, you will spend well north of probably north of $250,000 on medical expenses. So HSAs are all the rage and they're absolutely awesome. Now, in a future video, I will cover all of the rules and regulations around HSAs, so stay tuned for that. But please, like and absolutely subscribe, and I'll see you on future videos. Thanks a bunch.